The views expressed in this video presentation are my opinions and not necessarily the opinions of guests and others sharing or reposting this video. The content is produced only for educational and informational purposes. Do not regard any statements in this video as a recommendation to buy or sell any financial instrument. Investing comes with risk to loss of principal. Always conduct your own research and seek guidance from a professional investment advisor. I am not a professional investment advisor. I'm Dollar Will. Let's make some money. Let's see, before I start that, I want to see if anybody happens to be on these YouTube streets with me. Before I start that, I think I need to mute myself. If anybody happens to be. Okay. See if anybody's here. Oh, I got CR Frank. What's up, brother? Salute, salute, salute. So you've been keeping your eyes on these markets, man. I'm going to talk a little bit about the S&P 500 today, kind of get y'all focused on it. It's we need to really kind of watch this. I think we're at a critical point where we need to kind of watch this every day. You know, not every day forever, but every day in this particular moment, because it's at a critical point. And when this thing falls, not if, when it falls, it could move pretty fast. It could move pretty fast. Hey, what's up, Deshaun? Oh, okay. You never caught me live before. Okay. Yeah. I said, well, I promised yesterday that I would do something by this afternoon, and I'm late. I didn't get to it, and I'm gonna try to squeeze this in, and I may do something again in the morning. I'm kicking around the idea of starting up a sports channel, because Sundays is like, football is my thing, man. I got that addiction pretty bad. So, but I might, if I don't kick that sports thing off, they may not allow me to, because I haven't really set the channel up. I think when you start a channel, you have to wait like a day or something before they let you go live. I think there's a period of time, and if I'm too late for that, then I'll probably try to squeeze something in tomorrow about bonds. But I'm gonna go on and try to kick this off, because I know, it's a lot of stuff happening on Saturday night on these YouTube streets. So I'm gonna try to squeeze, get y'all set up before things get busy at night. Everybody trying to get it in on YouTube at night. So let me get this going. Good. Okay, I see that's working. Got the little delay in the YouTube screen, so I know that's everything's happening. So what we're looking at right here is the S&P 500, and this is, of course, what everybody's retirement account is tied to. And just to give us a little larger perspective of what's going on, has pretty this was January 2018. This looked like it was it, and then this was September, let's say a year ago this month, and this looked like it was it, especially when it made a new low, when this dive took out this low. And now we have this particular high in July. So this was, wasn't the end. This wasn't the end. Maybe the third time might be the charm. What's concerning about this particular move? First of all, in general, this move up since 2009 is considered like the longest bull run in recorded history, okay, history of markets, okay. So it's not one of these anticipated highs is going to work, okay. Another thing that's concerning as we keep getting these particular highs, we're not we're not moving very far, very much higher before it fails. So, the distance, don't look horizontally, but vertically. The difference between, this price and this point in turn on the price scale is not significant. And even the quote unquote breakout above this high here to this one is also not significant. In fact, it looks like we hit it again right here and failed, and hit it again right here and failed. We're not going to keep failing, okay? So right now we're flirting with maybe going higher yet again. We will see, but I'm saying even if we do, it's still not a good. It would be you're. This is like on that greed and fear and greed uh pendulum. We're on the greedy side right now. Everyone has made like tons of money in the greatest bull run in the history of markets, but then they're going to complain, of course, when they get caught holding on too long. you know so we're on the greedy side, and we're looking on the daily chart right now. This is the stochastic momentum oscillator, and it was overbought here. We took a dive, recovered, because this is what oscillators do. They go up and down. And so the issue is, where is the price relative to the oscillations? Okay. So we returned to the general area as its prior high, but we didn't make a new high, and the momentum is pointing down. And so we have what's known here as a little bit of divergence, in the sense that the momentum is pointing down, but the price really kind of looks to be going sideways. Okay, I can't, it didn't take out the low of this candlestick. It didn't take out this high, so we're just kind of going sideways. But the momentum is down, and we are in an overbought area, and we did not make a higher high. And so the fact that we didn't make a higher high is a concern. And this black line I drawn here, will increase the concern in the market if we break it, and if we go below this particular. Let me zoom in. If we go below low, this low point here of this candlestick, that would increase pessimism or increase concern. But ultimately, what will increase concern is if we take out this bottom here from August the 5th, okay? Because that would be the low point between these two highs, and that would increase pessimism that we're going lower. Of course, all eyes would be on this, but everything is kind of mounting right now. And I'll say, for my Patreon supporters, I need you to go on the page and tell me what's special about this particular candlestick here. That contains a warning that we talked about. And even this one kind of tipped you off to a warning, and it just kind of been petering along. Nothing to get really optimistic about, since we had this warning here and this one here. So the whole point that I try to make with technical analysis is to I guess affirm the point that the market is always giving us signals about what's coming next. We just have to learn to read them. Okay, so that's the point of it. So for my Patreon supporters, give me something. Just give me 1 or 2 words, literally 1 or 2 words. Tell me what this is, and tell me what it suggests may happen next. Um, what we have here is the options chart or chain for the S&P 500. And the options market is people betting in the future, whether the market is going to go up or down. A call is if you take the position that it's going to go higher. Put is if you take the position it's going to go lower. A lot of big money folks take positions in the market and the option in the take express a sentiment about what they think the market's going to do by placing a trade in the options market, uh, because you can hide your intentions in the options market easier than you can in the stock market. Okay, so a lot of times that is because a small amount of money in the options market controls a large uh, quantity of the thing that you're trading. Okay, and so a lot of whales, a lot of rich folks, they have too much money to go into the stock market and buy or sell shares directly that way because they have such a large amount of money. So what they'll do is come in and buy puts or calls in the options market. Also, rich folks that have positions in the S&P 500 or not going to say any, most stocks, they'll come into the options market and buy what's called insurance. So if you're long the stock market, you can come into the options market and buy some bets against it, some put contracts against your long position in the stock market as quote unquote insurance. So that if the market does fall, the value of your put contracts that you have will rise. So you sell, in that case, if the market was to quickly, take a dip, you could get out of the market in your stocks, and then you could sell your put options, your quote unquote insurance, and the increase in value in that insurance, if you've purchased enough insurance contracts, these are put contracts, can offset your losses in your stocks. And so that's another use. But the point of looking at this today is not to turn you into options traders, is to let you see how you can also peek over here and get a sense of what the heck is going on, or at least what their opinion is, what their sentiment is. And there's this thing called a put call ratio. It's the ratio of puts relative to calls. So if people are very optimistic, they would buy more calls. If the market, if the people in the options market are pessimistic, they would buy more puts. So they buy calls if they're optimistic. They would buy puts if they're pessimistic. And this is optimism or pessimism about the future. And in this particular case, it's about the contract that expires this coming Friday. So we're talking 5 trading days away. A ratio of 0.07. Yeah. No, 0.70. From 0.70 to 1.0, anywhere in there is considered, kind of like a moot point. But once it gets over, once this put call ratio, the ratio of puts relative to the calls, the amount of pessimism relative to the optimism, once that ratio gets above, say, 0.7 or 1.0, anywhere in there, it gets to be problematic. So what this figure here is telling you is that the bets against the market, the puts outnumber the calls at 3.86. So there are 3.86 times more puts than calls. And that's the sentiment of the market for the next 5 days of trading. So that's pretty high because it's over 1, so, and that's 3 times more than that. So yeah, on Friday, I looked out and saw the October 2nd date contract. It was at 10. That was ridiculous. And so, it was like 10 times the normal amount of puts. So that was especially alarming. It's not that now, and it's come down, significantly. I'm not even really sure where it may have come down to a more reasonable number, but it was 10 point something during the trading day on Friday. Let's see where it is now. Oh, come on. Oh, it's still higher. So even that's telling you, okay, so let's look at this. So if the pessimism on Friday, this coming Friday, was 3.86, whatever the distance is time between the 27th to October the 2nd. So now we're going even further out in time beyond next Friday, and the options market is even more pessimistic. So you would think that over a longer stretch of time, if in an optimistic environment, people would be more optimistic about further out into the future. But in the case of, say, relative to, I would say, Friday's put call ratio, this coming Friday's put call ratio, and the put call ratio of October the 2nd, it's getting progressively more fearful, more pessimistic. Now, let's go back to this chart here on the daily chart. We had the momentum going negative, so which is pessimism, and we have the options market bearing it out, and we got this trend line here that would really suggest pessimism if we break it by making this lower low. I think we're going to break it. Why? Because we're at a Fibonacci extension level at this high right here. We are in the longest bull market in the history of markets. Every time it makes a new high, it doesn't go significantly higher. And the options market is screaming that they don't trust it. And to stay in it beyond this point, I believe I'm not telling anybody what to do. What I'm telling you to do is go talk to a financial advisor. For me, I would be fearful. I wouldn't trust it. To stay in it beyond at this point, for me, would be an expression of greed and stupidity for me. This is my self-talk to me. The staying in beyond this point would be evidence of greed and stupidity for me. All right. We also have here a symbol called TVIX. This is really like Vegas betting. Okay, this thing goes down in the toilet as the S&P 500 rises. It also is it's related to that. Well, this is tracks the volatility indicator, the VIX. And the VIX is they call it the fear index. It's similar to looking at the options market to see how options are traded. Well, there's another market called the futures market that also is where a lot of big money folks hang out in the futures market, and they trade futures, and you can see how that those trades are going to see an expression of their opinion of the larger market. And so here we have this is an ETF because so many people want to participate in the actions on the futures market for certain symbols, but they don't understand the futures market. They created some ETFs which kind of move like some of the things would move in the futures market, and so you get the benefit of some of that price action in the futures market without having to have a futures account. So you can trade. So this particular symbol, TVIX, tracks the futures market volatility indicator of the S&P 500. So just as in the options market, you have people betting for and against it, long and short. Well, the same is true here. And the volatility indicator, when the volatility is going down, that means pessimism is down. The stock market goes up. But this symbol is starting to narrow. The range is narrow. It is expressed by this declining wedge. And we talked about this on my Patreon channel. This is and I'll put this in the box for you guys. Let me see. What am I trying to do? I'm going to put it here. Okay. You can read about that. That's one of many, and we go through lots of them, on my Patreon, so join and join in the fun. Let's see. So basically what happens is at some point, and we're very near the point where this thing is going to take off and break this line of resistance. And so the fact that it's narrowing is telling you that the moment of truth is coming. And so the people who are very good at trading options and trading futures, they know how to read these charts too. Okay. So all the folks who really make the market move, we're all looking at the same information. And we're not putting our hopes in Trump tweets. Okay. Okay. So no Trump tweets here. And we're oversold here. And so that means there's only one place left for this oscillator to go is up. So this is fear, pessimism, no place for it to go but up. And so when it goes up, will it break this line and start a new trend, ending this downtrend? This downtrend would be, see, I'm trying to flip my mind. This would be optimism. The fear indicator going up, when it breaks up, that's the end of the optimism. And so this wedge is kind of tipping us off to that. And, these are lots and lots of pictures of it. And I'll show you. I'll put this in the thing too, just so you can kind of see what it looks like. But you'll see over and over again, it breaks out in the opposite direction. Let's see. Let me get back to where I was. All right. Oh, another way of kind of keeping an eye on what's going on is you break the S&P 500 is the 500 largest. It's an index of the 500 largest companies that trade on the U.S. Stock market. The small cap index, this one here we're looking at, it's called the Russell 2000. It is there are about 5,000, about somewhere in the neighborhood, about 5,000 stocks that trade on our market. And the S&P 500 represents just 500 of them. That's where you're going to find your Apples, your Exxon, your Procter and Gambles, and, basically the ones that make the news all the time because, those companies being so large, they control a whole lot of money. They would consider like the safest investments. And so when the big companies are in trouble, you know what rolls downhill. We all know what rolls downhill. Okay. And now the smaller companies, they have less money in their coffers to be able to weather a storm. So they would be like the canary in the coal mine. And this index represents the 2,000 smallest companies that trade in the stock market. In this 2,000, it also includes penny stocks and all kinds of stuff. All right. So we basically, the small caps, like the canary in the coal mine, they usually get sick first. We call that term canary in the coal mine is what the canary has, like a weak respiratory system. So the coal miners would take the canary down in the mine shaft with them. And when the canary died, because of those gases and stuff that you can't smell, that we can't smell. So if the canary died, that means get your ass out of there, basically. And so the canary, also known as the small caps, its high was, I'm looking in this information box, it keeps jumping. You look at the top of it, the top line in the information box says 8/31/2018. The small caps hit its high a year ago last month. Okay, so it can't do it. So it's like catching it. So we have what's here is a symmetrical triangle, which is also one of those symbols that's keying us in that, hey, it's not enough gas in the tank, not enough steam. So it's either, in this case, the fact that it's occurring at the end of a trend is troublesome. All right. So just as I said on the other channel, on the other one, when we got near the narrow point of the triangle, showing that the range had narrowed, the price broke below the floor, it returned back up. This support now is functioning at present as resistance. So although the price rose back up, this high here is not higher than this high here. Let me go back and go in a little bit. I just want to go in about here. Let me see something. Yeah, that was enough. It's got, what's that, 159. I'm looking in the information box where it says high. That's on the left there. It says 159.23. So that's that high. Let me see which one of these is the high. This one says 158.92. That's not it. This says 158.75. So neither one of these made it to 159. And this high was 159.23. So we did not make a higher high. And so that's important because in downtrends, you make lower highs and lower lows. And so you have a high here, a lower high here, a lower high here, a low here, a lower low here. So from this point, which is May of this year, May of this year, May 6th of this year, the downtrend has resumed. And we must regard this as going down until it makes a higher high. Now, could this momentum flip around and go up? Sure. But we don't hope for it. We don't hope for or against it. We just follow the money. Okay. So, but we are overbought. The momentum is going down. The question is how far will it go? But so you got the small caps telling you the canary is died. The canary is dying. Okay. And you got all that information from the options market in the S&P, and you got the candlestick alarms on the S&P. All of that is screaming that this market is not healthy. You got the price return to the former support. This line, black line here, was supporting the price trend. Now it's resistance to the price. Okay, so unless it turns higher, so there's a preponderance of information here that's suggesting that this is dying. This trend, which has been the strongest bull market in the history of markets, that it has seen its high. But we keep our eyes on the chart, and we trade accordingly. Let me check the chat. See how you guys are doing over here. Get rid of this. See what we got here. Yeah. It's a lot to learn, brother Deshaun. But we got to make it a priority. We got to make it a priority. It's really not hard. It just takes a time commitment. But I can't really say that it's difficult. It's about as difficult as exercising and eating right. We all know it's important, but it's not hard to do. It's hard to find the discipline to do it, but the act of going out for a 45-minute walk every day and planning to eat right, that's not hard. I mean, yeah, I can't say any other way. The discipline itself is hard, but it's doable. It's doable. It's just a matter of priority. I mean, whenever we make it important, we make the change. We solve it. But yeah, I hear you. That's right. One of the main aspects, brothers, should be focused on is building. Oh yeah. We got to fix this. I put it like this. As a trader, again, I'm like, I'm not. I don't have an emotional connection to prices moving up or down because I can make money based on whether it's moving up or down. So my focus is on making sure that I'm being objective and reading the signals that the market is giving me so I can make money off of it. And so with us being at this extreme high, this you make your money getting in at the beginning of these long trends. Trends last for years. Okay. So in 2009, the folks that got in near that bottom that's been riding this whole wave, if they make this one decision right, if they're sitting, if they have, say, $500,000 or six figures, or really any amount, but especially people who crossed over into the six-figure region in their retirement account, if they make this one play right, if they start to learn technical analysis right now, and they follow like my channel and other channels, and try to get this. It doesn't take years to get this. It takes months to understand it, to be able to make decisions about it. And then you just start to get better and better and better. But just to understand how things work, how money moves, that doesn't take years. That just takes months. But someone that has a six-figure amount in their retirement account, this one move that we're negotiating right now, that I just talked about in this video, if they just get this one move right, if all they do is and getting it right, that means either getting out of the market and not losing any money, or following along and with what I talk about here. Hey, maybe even joining my Patreon and really get the dope, because I give out a whole lot of stuff there I don't get into here, because I can't give it away. I just there's too much of my life into this. But back to the point, for the people, if they make a move either to just to protect the money that they've earned and come back in the market when the decline is over, which is likely to be in the neighborhood of 2 or 3 years. Okay, because I don't believe there's been a decline that's lasted longer than 3 years. So 2.5 has been what the past major declines have been. Okay, so like the big one from 2007 to 2009, the quote unquote Great Depression, that was only like 2 years, something like two, not over three, in that 2 to 3 year window. And so history dictates that this decline will only take about that same amount of time. So and we have computers today, so it might even, who knows, it might happen even faster. So we have more information, and we can make transactions a whole lot quicker. So it might even be over much sooner. So that's the good news. The bad news is it might even be over much sooner because I said the same thing twice. Because if you're not watching the charts and you just going by your own faith and the fact that it took a decades for the markets to rise, and so you have this lax attitude that, well, I can get to it next month. These markets can wipe out several years in a month. A calendar month, you can look up and you can be like, several years of your gain can be gone. So there's a saying in the stock world that prices take the escalator up. I'm sorry. Yeah, yes, prices take the escalator up and the elevator down. Prices usually fall much faster than they rise. And so when people aren't paying attention, they think that, well, I've watched my statements every quarter and it's moved about 5% or 10%, so I can get to it next month. And then they put it off for 3 months and seeing they've lost 50%. That's how quickly things move. So the people that lock in, and that if they happen to have like I said, then if they're fortunate enough to have, I don't care if you got a six-figure balance in your account or if you just got $10,000. If the ones that get out and come back in the bottom and learn, take that time to learn while they protected their money, or the ones that are learning along here, and they have a little boldness and profit as the market is going down, because there are ways to do that. That TVIX symbol that I showed is risky as hell. I'm gonna tell y'all that that thing is risky as hell, and that is not for people who a not gonna watch it, b don't know how to read charts. So that would be one I would say you put like Las Vegas money and something like that, and all of it. I would say, of course, go find a financial advisor, and but that would be one that you put. People routinely go to Vegas and lose. You people lose $2,000 or $3,000 in Las Vegas and call it entertainment. Okay, I haven't been to Vegas or any place like that in about 15 years, because that's not fun for me. Since I started trading, I can't call that entertainment. But when in my Atlantic City, Las Vegas days, and we talking 15, 20 years ago, I would, blow 3,000 and call that fun. So, and with the kind of money people have now, people probably routinely throw away more than that. So with a small amount like that, if you do it right with these declines, we're talking about 1,000%. Or some of these highly speculative things like TVIX, it's nothing. That 1,000% is doable. So somebody with a six-figure amount, we got some. There are other stocks out there that's not as risky as TVIX. It might be possible. It's possible to do 1,000% in one of those, but you have to know what industry to pick, and you have to follow the right the channels like this one, and you have to not get distracted by the news telling you stuff about Trump tweets and stuff like that, because that's not what's going on. You gotta. The thing about technical analysis is we are watching real money flow, and so you don't need anybody on the news to tell you what's going on, interpret it for you. You can look right at the charts and you can see what's going on, and you'll notice the news stories kind of follow the money. People, countries fight for reasons just like we fight for reasons in the street. In one way or another, it all comes back down to money. Okay, even if somebody say no, it's power. Well, power gets expressed through money, so it's still gonna come back to money. And there's nobody, no country, or no person with power that's not somehow making money manifest from that power. So you bullying somebody, you pushing somebody around with that power. Okay. So let's see. Deshaun says what is recommended for older investors to do with their money is taking out the market due to recession. I'll say at first, I'm double nickel. I'm 5'5". I'm 55. All right. So for older people, it's especially crucial, because if you're approaching retirement and you don't get this right and you get creamed in this market, you're not retiring. You're gonna be a weight on your kids and family. Um, so I would say you definitely need to be talking to a financial advisor. And I'm very serious about that for older people. But I'm gonna give you my opinion. But I'm still gonna say you definitely need to be talking to a financial advisor. Talk your retirement account. Usually they have like a plan advisor or something, and they always offer free. They have to give you some amount of free consultation. The quality of it, but it's there. Go get it and ask them. Say, hey, if I'm worried about the stock market, what should I do? I don't want to have my money destroyed. I want to be able to retire on time. And they can tell you, okay, if you're concerned that this is how your portfolio should be balanced. Okay, they'll tell you that. And then you take some information that you're getting here and you can go ask them. Say, this is, some guys on YouTube saying, that I could do this. I mean, what do they, and they'll look at it and go, okay, well, yeah, you can do that. If you feel a little risky, maybe they'll tell you that I think you should only put this much into that, and you kind of work it out with them. A lot of banks, or in credit unions, especially credit unions, they have, financial advisors, and you can get free or cheap advice from them. And then thirdly, you can hire someone on your own. I think what is this? Is it CF? I can't remember that daggone site that Mike V is always giving out on the Brain Trust. I'm going to get it and put it in the comment section later. Um, but it's a site that helps you find a financial advisor. But that would be the first thing I would do. Second thing I would do is, this is for me. For what I would do, I'd get out. If after when I say get out, I don't mean when you keep your money in the plan. Your money in your retirement is invested in stocks. I would make sure that I was not invested in stocks. So you can move the money to, say, a money market account. I mean, from what's still within the retirement plan. Because if you leave the retirement plan, that would be horrible. Because then you're going to pay taxes and penalties and all this stuff. No, you don't. So when I say I would get out, and again, I'm not telling anybody what they should do. I'm saying what I would do. I would get out. And if even if the market inched higher, I wouldn't worry about it. I would be more concerned with protecting what I've earned than making money. I'd be more concerned about losing money than making money. And so I would get out, or go talk to a financial advisor and get them to help you redistribute it. So those two things is probably the same thing, because they're going to look at you. If you're older, the financial planner is going to say, at your age, with you being this close to retirement, you should not be so heavily invested in stocks. So their advice is going to have the same effect of getting you out of stocks. Okay, and they're gonna either some or all. They're gonna show you how it should be distributed, and so that would be one thing I would do. The first thing I would do, if I knew a little bit and could do and balance it on my own, I'd do it. But I think getting the free help from a financial planner, why not? It's free. Go build that relationship with someone. Then for me, I would pick industries that are going to rise, and you will hear me talk about that coming up. I got my eyes on some. All things don't go down at the same time. I'm dollar will. The dollar movement is the most important financial instrument on earth. Once you know the direction of that dollar, you can figure a lot of other things out, because the dollar is the first domino in the chain of other dominoes. So you know what the other dominoes are going to do once you see what's going on with the U.S. dollar. So I would personally, I trade industry-based ETFs. I don't buy individual companies. I'm a technical purist. I just trade the charts as they relate to industry-based ETFs. So I buy whole industries and not individual companies, because I don't care to be reading information about how this company is doing, just to find out that there's a class action lawsuit against the company, or the chief financial officer lied and now the company's being investigated. I ain't got time for that. So when I buy whole industries, any kind of malfeasance that happens with one company, it's not going to blow my whole trade out the water. So that's my overall approach to investing. I trade the macro, as we call it, the macroeconomic trend, as dictated by the movement of the U.S. dollar. So that's why I'm dollar will. So I got my philosophy locked in. I can't say that my way makes the most money. I'm sure that there are some individual companies that outperform the ETFs that I trade, but like I said, I don't want to be locked into the risk associated with one company. And I make enough money. There's enough money to be made. Let me put it that way. Trading ETFs and technical analysis, it's great, because it'll tell you when. People say you can't time the market. Yeah, okay, we can get real close. We can get real close, you know. So let's see. Let me check it out. What we got? Did I did I answer your question, Deshaun? He said he's fairly young, but many years to go for. Oh well, then you definitely need to duck this. Let me I told the story before, Deshaun, but I got into trading when I was in my 20s. Um, to be brutally honest, I got into it for egotistical reasons. I was on the job. I was about 23, and there was this white guy on the job that was 2 years younger than me, and he just seemed to know a whole lot about stocks, and I didn't know anything about stocks, and I asked him, I said, man, how do you know all this stuff? He said, my father taught me. I'm like, I had never heard anybody in my family talk about stocks, and so my ego and pride I got in my feelings, y'all. I said to myself, this guy ain't better than me. He ain't smarter than me. I ain't like the fact that he knew something about something that's important in stocks and I didn't. So I went to Borders bookstore and I bought me some books and start learning about it. And I got into it the way that most people do, into fundamental analysis. And I was trading fundamental analysis style with this was during the .com days. This was the 90s. Okay, this was so I'm fast forwarding. Um, so yeah, so this was the 90s, right? The .com. But when I bought a mutual fund that focused on internet stocks. So I was already kind of into the whole thing of investing in specific industries, even back then. Because what's the guy named John Bogle from Vanguard? That's what that's what he was into, and I was influenced by him and Warren Buffett and some other people, and he just made a lot of sense. So I said, well, let me go for this internet fund. And the mutual fund was ridiculously low. It might have been $2 or something to get into the fund. And the daggone thing went from like $2 to $10. And I had just $50,000 in my retirement account. I was in my 20s. I saw that daggone thing move from 50,000 to 250,000. I said, wow. So what blew me out, I'm like, okay, it multiplied 5 times. And so I'm sitting there doing the math. I'm like, okay, if I can repeat the same process and go like 250,000 times 5, that'll put me over $1 million. So I thought I was going to be retiring in my 30s. And then the market turned and I lost all the money. And I was pissed off for a long time and I wanted to find out why. Long story short, I found out the people who made money and were able to keep it, who knew to sell, were the people involved in this thing called technical analysis. And so I started to study it and transition to away from fundamental analysis. I'm still pretty bitter about that particular school of thought. I don't really have a whole lot of respect for it. Just a little bit, just a little. Fundamental analysis is pretty good if you're trying to pick one stock out of an industry and you want to know what's the I'm trying not to say best, because what does best mean? What what's the what company is making the most money, the has a good business model in that particular industry? What's the best of the bunch? Fundamental analysis is good for that. If you want to really make a lot of money and you use technical analysis to pick a hot industry, for me, I'll just buy an ETF at that point. But if you want to make the absolute most money from the hottest industry, then fundamental analysis can help you and you want the company to have a real business with real customers making real profit. So all of those conditions then fundamental analysis is great for that. But for me, technical analysis, we invest to make money. And these gray hairs on my head and being around during that dot-com bubble taught me that a lot of crap goes up, just like Bitcoins and cryptocurrencies, okay? It don't even have to be a good business. It can be crap, and people will buy it. But if you sell before it tanks, who cares? Also, great companies with great products, they tank too. That's what I learned. So it's a myth that you're safe if you're investing in a company that has real products and they're making money, and therefore, because they're making money, that stock is not going to go down. That's a lie. That's a lie. And I'm going to demonstrate that in real time on this channel. So you have to throw that out of your mind over here on the technical side of things. Okay? People sell the stock of great companies like Apple. They sell those stocks because the stock has run up too high. And the investor is disciplined enough to know that nothing rises forever. And so they contain their greed and they get out and they go find something that's been beaten down into the dirt that's going to be the next thing to rise. That's what they do. That's what they are doing right now. And those places, I know where they're going, and I'll be bringing those forward on this channel. I'm already, definitely going to be doing it on my Patreon channel, because we follow the money, so. And let's see what does Deshaun got me. He says, best time to invest is when investor is young. Yeah, absolutely. Absolutely. But if you're not young, it's always the best time, Uh, the thing is not to put money in and just walk away. You need to learn how things work. Because somebody that's just entering the market right now and they are doing what they call dollar cost averaging. That's when you take a little bit of money every paycheck and just put it into the market. If you come into the market during this downturn we're getting ready to have, let's go back to say like 2007. Let me see if I can show it. I know I can. Let me go to this S&P. This is the S&P 500. I think I need to go to the weekly. Because people are told you can't time the market. You should just put money in and don't think about it. No. Try to learn what the heck is going on. That's horrible information. But that's what people are taught. They're telling you that you're too stupid to understand, and they're telling you that it's okay for you to say that you're too busy to try to understand. What's more important than your money? Okay? I have people say, well, I don't feel like sitting in front of the computer all day. Then they sit in front of the computer all day and watch YouTube and do other things. Well, what's more important than your money? So, I mean, how much time are you willing to set aside to try to learn? So if somebody got in, followed conventional, quote unquote, oxymoronic wisdom, okay, and they bought a few stocks every paycheck during this decline, they were throwing good money after bad. And so this high was, I'm looking in the information box in the upper right, that's October the 7th. They didn't break even, get their money back until May of 2013. It took them 6 years. And then what do people, well, here's the comeback. Well, you got time, look, you could have been investing in something else in this whole 16-year period. Everything did not decline. Okay. So, but as a technical trader, we know where to go, and we avoid this. We're not going to have you throwing money in a hole, for 6 years. Okay. Um, It just makes no sense. So you need to be learning. So you said what to do. And so when the people were at this point, they need to be learning. Someone should have been telling them that you're being greedy right in here. Go sit your butt down and open a book and learn. And it's not going to take, 2 years to learn. Okay. You're going to get the concepts probably in, 3 to 6 months. You're going to have all the concepts. Or definitely 6 months. Let me say more like six. You're gonna have the concepts if you got you're reading the right stuff. And then it could take you I would say a good 2 or 3 years of practice to really get good. And then you will be in a position to catch this run. Okay. So you go back to dollar cost averaging, but you'll know when you hit the danger zone where we are now. Okay. So that's my story. That's my story. Let's see what we got over here. All right. Well, thank you, brothers, for riding with me, rocking with me. If you got any more questions, shoot them in right now. I'm gonna get off of here. I want to do one on bonds, but maybe. I know there's some other night shows that folks rock with, but that bond yield chart is looking pretty interesting. The bond yield, bonds are boring, but they also give you a clue as to what's going on, because money will rotate from the stock market to I would say bond yields in particular. And it looks like there's some this interest in some of these bonds that is happening at a curious time too, because you got a lot of smart people that have made a lot of money during that 10-year run of the S&P 500, and they, like I said, they're looking for a safer place than staying in the S&P 500. Remember those the put call option ratio and all of that. Those folks are going to take that money someplace, and so they're looking for those places, and I got a couple of them identified, and bonds is not the bond. I give tell you this much on the bonds. You got the face value of the bond, and that's the bond bubble that everybody's talking about. Then there's the bond yield. So the face value trends up, and that kind of trends with the pretty much with the stock market. Then you got the yield, which is the interest paid on the bond, that trends down. And so money rotates from one side of that bond, like from the face value to the interest rate, the yield. Let me say that, the yield. So, and so you can see that interest, let me say, not the word interest as in bank interest, but not a price appreciation. You can see that demand. There you go. You can see the demand move from one to the other. And technical analysis it's all about following the money, following the price action, as we call it. And you don't have to wonder about where to invest as you get into technical analysis, because all the tools show you. You learn to use the tools. They show you exactly where money is going, and you follow it. That's what we do. We riding down the street and chasing a Brinks truck. That's what we do. We just follow the money, and we'll figure out later, after you get where you're going, then the news cycle catches up to what happens. That's the weird part about trading. You got to get used to being really ahead of the news, because the stuff that they talk about on the news, it's behind what's happening. It's behind the ball. And so you kind of like you end up this weirdo out on a ledge, only able to talk to a few people, which is other traders, because they're the only, because you together, you're really the only ones following the money. And because all the news and stuff, it's like follows the money, you know. So, hang out with me here some more. Consider joining my Patreon, you know, because you just got to get this one move right. Because if you're sitting on a 6-figure retirement account, or even say 50 grand in your retirement account, if you can turn this opportunity and this decline in this market to say, just add 1,000% to whatever your balance is in your retirement account, add a zero to it. Whatever the amount is, add a zero to it. That's the kind of gain that you can have. So if you're in your 20s, it is entirely possible. It's not a stretch. It is entirely possible for you. And I'm going to be conservative with this. You can be retired in 10 years, possibly 5, if you get this right. If I had gotten it right when I caught that run up to $250,000 in my internet mutual fund, I did not know technical analysis at the time. Money rotated from those from the NASDAQ, basically. We're talking about way back in the time when Apple was $12 and $10 and stuff. Okay. And if I had known technical analysis, I would have known to rotate my money into gold. Gold traded sideways from like the early 80s until 1999, almost 20 years. Gold traded sideways almost 20 years. Nobody cared anything about it. It traded up around the $250 area, and then it broke out and ran up to about $2,000, 1,800 to 2,000 in that area. And that peak was in 2011. So gold took off on a run that lasted about 12 years. And the dollar, of course, got destroyed if that was happening. So the dollar has been in a reflexing, moving up to crawling out of the dirt, based on a destruction that gold caused to the dollar when gold rose in, say, 1999 area up to around the 2011. So the gold, the dollar reflexive move higher is not over. Okay. And so this decline in gold has been declining since 2011. Oil has been declining since 2008. They both have more to go, and the dollar has higher to go. But when that's over, it will be time to invest in gold and oil, and we will be thrust back in time to the Beverly Hillbillies, when Jay Clampett struck oil, but nobody's talking about that kind of stuff. Oil and gold, they're going to be like the new Bitcoin, and Bitcoin will even be good to invest in at that time. But I wouldn't buy Bitcoin, gold, or oil with your money right now. It's all about that strong dollar right now. But when that run is over, and it will be over, that dollar is going in the garbage. It's going to spiral to hell. And so all these brothers doing all this tricking, it's all because they don't even know it, because they don't know that they're participating in this dollar strength move. That's why we're able to travel, because the dollar has been rising since 2011, pulling itself out of the dirt because of the destruction that gold caused when it rose from 1999 to 2011. And so that means now that your money is stronger, allows you to travel all these other places. But at some point, the dollar is going to resume its downward trend, and we won't be traveling At least not to Europe. That will be out of the question because the euro is going to be stronger, and your money won't go as far when you travel there. So for those brothers that's into the travel game, they definitely need to be getting their trading game up, so they can understand that the life they're living right now with this international travel, it's not going to last. If they don't get wise about trading to learn how to profit off of the move of this dollar, they're not going to always be able to travel like this. So it's not a see. I watch those shows and I hear those brothers talk about, well, people should just get their passport. The time. Why didn't we know about this? Well, you didn't know about it because it wasn't important. Because this opportunity really didn't always exist, really, because the dollar, this relationship with the dollar gaining strength against these other currencies. So we are enjoying, I guess, the effects of a currency move. That's basically it. And if they don't get their trading game on, they won't be able to continue to live that life. And I'm rooting for them to continue to live that life, and I'm hoping they, get with this trading. So any other questions? That's all the rambling from me. I'm out. Peace.